There's no shortage of excitement these days in the world of precious metals. Today is no exception. But what makes it very odd is how both gold and silver performed. I'll explain what happened and what we should be looking out for in the days and weeks to come as we explore. Gold and silver moved in opposite directions today, which is strange. Usually they do run in tandem, although at different paces. But this time they have moved in almost exactly the opposite direction at exactly the same pace. Yea, though, silver is underperforming or outperforming that pace, but to the downside. So here's where we stand right now, moments before the markets close. Gold is up. And having reached an all-time high yet again, it got almost to $12 away from $3,100. But right now it is up $25, up 0.82% to $3,082.60. Silver, on the other hand, is now flirting with going below $34 an ounce. It is now down 37 cents, down 1.09% to $34.09. In fact, in the bid price, it is below $34. Still, silver's doing okay. And one clue we have as to why silver is moving that direction as opposed to gold is what platinum and palladium have done. They are both down as well, but not by as much. Another thing that we should look at is the base metals. What are they doing? Well, copper is up only marginally, but it is up. And nickel is down slightly, and so is aluminum. And crude oil is also down slightly. It's down about 1%. And by the way, the Dow Jones Industrial Average, the NASDAQ, the S&P 500, the New York Stock Exchange, and all the other markets are down. And also, so is the dollar index is down. So in that sense, silver really should be up. You know, we could look at it as sort of a smackdown, the Friday smackdown. We're kind of used to it with regards to silver and to some extent gold, but gold is bucking the trend today. So in a sense, it's a little bit weird to see that happening. So what is behind gold's price going up and what is behind silver's price going down? We're going to get into that in a moment. And gold's price reaching a record high, you can still get in on gold, although many people feel like, and they have adjusted their forecast to go up higher. You should only make a decision based off your level of understanding and research on where the gold market is going to go. But if you're in the market and want to get in, check out Summit Metals. They have these really cool wallets, and I like to get these little 1 gram bars, and you can fill this up. It takes 12 of them to fill that thing up. And a little bit slow going in it, but I'm going to fill this thing up, so stay tuned. You can watch me fill this up. But they sell these really cool wallets, and you can get these 1 gram bars from Scottsdale at a very low premium in comparison for gram bars. So check out summitmetals.com for that. And let's get into what's going on with the markets. Now, it is largely the uncertainty and the chaos behind the tariffs that are going to be implemented. We know now that the tariffs indeed will take effect, and there's going to be a permanent 25% tariff on autos. But just breaking news, Donald Trump had a good discussion with the interim prime minister, I guess, of Canada, and Carney, I think is his name, Mark Carney. And apparently it was a good discussion. We'll see how that plays out. But gold is having none of that. It's still rising, considering that the tariffs are going to take effect next week on the 2nd. It will be the first day, and then the 3rd, and then on the 3rd, the auto tariffs will come in at 25%. Surged to a record high again on Friday. Gold has, according to Reuters, flocked to the safe haven asset amid fears of a global trade war triggered by Donald Trump's latest tariffs. And U.S. gold futures have settled higher as well because of that. And in fact, at one time, they got up to $3,114.30 in the futures market. It continues to be a safe haven demand on ramped up concerns about tariffs, trade, and ongoing geopolitical uncertainty as well. That is supporting gold, according to Peter Grant, Vice President and Senior Metal Strategist at Zaner Metals. Gold, traditionally seen as a hedge against economic and political instability, tends to thrive in a low interest rate environment. The personal consumption expenditures price index increased 0.4% in February, compared with analyst expectations of a 0.3% rise, similar to January's increase. The data isn't likely to change rate cut expectations very much, as it's only a little hotter than expected, Grant added. The Fed has held interest rates steady so far this year in 3 rate cuts in 2024, but hinted at a potential half percentage point rate cut later in the year. The market is currently pricing in 63 basis point of Fed rate cuts by the end of the year, starting first in July. Markets are now bracing for Trump's plans for reciprocal tariffs, which he intends to lay out on the 2nd of April. His policies are perceived as inflationary, posing risk to economic growth and escalating trade tensions, according to analysts. Of course, that is not inflationary, that's just price increases. Silver fell 1.4% earlier in the day. And platinum has eased a little bit as well. And of course, they don't give the reasons there, but you have an idea that it is because of the economic situation and the potential demand down the future, if there's going to be a recession, silver actually may hurt because of that. Silver may suffer because there will be less demand for silver during recessionary times, which is why people say that usually silver tends to recover and go up at the tail end of a recession, once demand picks back up again. And of course, we know what's coming as well. On Monday is going to be the supposed silver squeeze. And you know what's interesting about manipulation and what has happened, a lot of that has happened with gold back during the time, and silver as well, mainly by the government. The Exchange Stabilization Fund was established in 1934 to intervene in foreign exchange, credit, and gold markets. The ESF was initially funded by part of the U.S. government's paper gains from revaluing gold from $20.67 to $35 per ounce. Since that time, the U.S. government has intervened in the gold market to try to hold down its price. While trying to hold down gold's price became too much for the U.S. government to do it on its own because demand exceeded supply, it established a consortium with 7 other central banks in 1961 via the London Gold Pool to continue the effort. But it started failing in June of '87 and totally collapsed in May of 1971. The collapse of the London Gold Pool led to then President Nixon closing the U.S. gold's exchange window on August 15, 1971. In 1974, the commodity exchange known as the COMEX began trading gold futures contracts as another means to suppress the price of gold through traders selling contracts for gold that they did not physically possess, which is called short selling. COMEX silver contracts trading also began in 1975. The COMEX markets are overwhelmingly markets for trading paper contracts rather than for delivering physical metals. We know that. We've seen the derivatives market play out in that regard. Over the past month, the daily COMEX trading volume for gold has ranged from 16 to 34 million ounces. The COMEX trading volume over the past month has ranged from 161 million to 641 million ounces of silver. That is often the volume traded in the physical market. When annual new gold mine output is around 100 million ounces and silver output is over 800 million ounces, closer to 825 million ounces. So the prices of gold and silver are more heavily influenced by the trading of paper contracts. The LBMA trades even greater quantities of paper, gold, and silver than does the COMEX, and they are affected by physical supply and demands for the metals, and they've gotten very low, especially in the silver category. The price of gold, and we've seen the price of gold as of Wednesday this week is up more than 46% since the end of 2023, whereas silver's price is up more than 40%. So now gold is outperforming silver since the end of 2023. And many people feel that is because of the strong physical demand from central banks and private Chinese citizens holding up the price of gold. That's what's happening there. Yet silver has also been strong because of rising industrial demand, particularly for industrial usage and photovoltaic products such as solar panels. But some feel that that could be dying off a bit as well as we come into the next weeks and years. Physical gold demand has been so strong over the past year that selling short gold futures contracts has become highly risky. However, it has not yet been that risky to sell silver contracts short, especially if you are JP Morgan Chase, where you have a massive physical quantity of customer silver in your vaults that you could purchase, lease to make delivery if necessary. If only the physical demand for silver could overcome that paper market short sellers, the spot price of silver would almost certainly take off much higher. But and then they talk about what's coming up on March 31st, but there's just not enough silver buyers out there, and there's not enough of us to have that much of an effect. It's going to have very little effect to partake in to buy physical silver that day. And plus, when you think about it, if you're saving to buy up for the March 31st, that means it's time you're not going to be buying otherwise. And that leads me to another aspect of here, and this is something a little bit of a contrarian thing about, a rising tide lifts all boats, and if gold is that rising tide, it's not lifted silver, at least especially not today. And while gold is enjoying this epic run over the last 12 months, silver has only just about managed to keep up when it should, by tradition, have risen significantly over. Silver could normally be relied upon to massively outperform at these inflection moments, but it hasn't. Silver's coming along for the ride, but very clearly, reluctantly so. Meanwhile, many of the commentators out there are claiming silver's about to go parabolic to the moon. The elites are losing control. Massive short covering is imminent. And yet they never stop to consider the consequences of this hyperbole. And that really is what it is. And that's why I don't do that on this channel. I talk about it, and I also am open-minded to some silver price manipulation. But what's going on with silver? There's a lot. It's a very complex market, and they fail to understand how markets work, according to Ross Norman here from Metals Daily. Banks are long physical and short the futures. They are square barring the time mismatch between these different trades. They are price neutral. It's a mechanism to borrow or lend metal to companies for financing or inventory management, such as refining, work in progress, or mine production, or other. Some will know this but think it's too good of a story to pass up. Well, and the thing is that almost sounds suppressive anyway, just by the definition of it, unless I'm missing something here. So I'm not sure exactly what this means. Let me read this again. It's a mechanism to borrow or lend metal to companies for financing or inventory management, such as refinery work in progress or mine production. Well, a lot of that silver that is used for industrial purposes, it's before it hits the market, before it's refined. But anyways, let's give the banks a kicking anyway, is what they're saying here. Let's make the claim, and maybe everybody else will pile on, and we get what we hope for. But it doesn't work like that. Those who are silver bugs are already in on the trade. They are long silver, while those who might be minded to buy silver, and it has some great fundamentals, are put off because who wouldn't want to enter a market that is fundamentally flawed? But for the same reason they fail to see, they are working against their own self-interest. And to that I agree. We should stack silver not as a means to get rich or some hope that it's just going to bust wide open, but to preserve your wealth over the long course of time. Silver still does that. The fundamentals of silver have not changed, no matter what you feel about the markets and the market participants. If you keep crying wolf, you do not educate people to hate wolves. You only teach them to mistrust the messenger. And this is why I am encouraging my viewers to not, that's right, do not buy silver on March 31st. Don't participate in it unless you just want to buy it and it's just your regular day to buy. It's not going to work. It never has worked. These silver squeezes never do anything other than just to enrich bullion dealers. And I'm sponsored by one, and I'm telling you that. But more importantly, this sponsor of this channel, Summit Metals, cares more about you, the customer, and it is in their best interest that you buy not because that you buy because you understand the metal, not because and then to buy on a certain day and it doesn't happen like you think it will by paying higher premiums or what have you, and then you get burned down the road, and then you're not a buyer of silver anymore. See what I'm saying? That's the message there. So we'll see how this plays out. But both these metals are trading in opposite directions today. The volatility will continue, but gold and silver shall remain constant for what they have been for thousands of years, stable stores of value amidst price fluctuations, and that's what it's all about. Let me know what your thoughts are in the comment section down below. Hope you found this video informative, insightful, and educational. Would like to extend a multitude of gratitude to each and every one of you for taking the time to watch this video. I want to remind you one other thing considering the trade situation we find ourselves in, the tariffs. I just have displayed for you here gold that is in North America. We got Mexico, we got Canada, and the United States. And that is all going to be affected by the tariffs coming up here very, very soon. So a multitude of gratitude to you all.